Turn on the news for 5 minutes, and it feels like the world is unraveling. Every headline seems to bring another crisis. War, rising oil prices, stubborn inflation, growing fears of a global slowdown. People are feeling the pressure everywhere. Rent is expensive, groceries cost more than they used to. Job security suddenly doesn't feel so secure anymore. With everything around us feeling so uncertain, you'd naturally expect financial markets to reflect that uncertainty. Instead, it's breaking records. The S&P 500 keeps climbing to new all-time highs. Something doesn't add up. How can both of those things be true at the same time? Has Wall Street completely detached itself from reality? Or is the market being manipulated behind the scenes? The truth is a little more complicated than that, because one of the biggest myths in finance is that the stock market reflects the health of the economy. That's why most people assume it works like this. If businesses are thriving, stocks should rise. If the economy is struggling, stocks should fall. Simple. But markets don't work that way. The stock market isn't designed to reflect how ordinary people are doing, and it certainly isn't measuring how peaceful or chaotic the world feels. Instead, every second of every trading day, the market is trying to answer just 4 questions. How much money are companies likely to make in the future? Where are interest rates heading? Where is investment money flowing? And what traders and large institutions are buying or selling right now? Once you start looking at the market through those 4 lenses, record-breaking stock prices during periods of global chaos suddenly begin to make a lot more sense. Although, what they reveal isn't necessarily comforting. Most people picture the economy as a simple chain reaction. When businesses are confident, they hire more people. Consumers spend more. Companies earn bigger profits. Share prices rise. When uncertainty arrives, the opposite happens. People cut back. Businesses slow down. Profits shrink. Stocks fall. It's an easy story to believe because, on the surface, it sounds perfectly logical. The problem is, the stock market and the economy are not the same thing. They're connected, but they're far from identical. Let me explain. The stock market is largely driven by a relatively small number of massive publicly listed companies. Take the S&P 500 as an example. Most people imagine it's a perfectly balanced collection of 500 companies, each contributing roughly the same amount. It isn't. A surprisingly small group of corporate giants accounts for an outsized share of the entire index, which means headlines celebrating another all-time high don't automatically tell you that the average person is doing well. They may simply tell you that the largest companies in America are producing extraordinary profits, or that investors believe they'll become even more profitable in the years ahead. But that's only part of the story. Markets don't rise simply because companies are performing well. Sometimes they rise because reality isn't as bad as everyone expected. Imagine finishing an exam convinced you've completely blown it. You've already accepted that you're getting a terrible grade. Then the results come back, and you've managed a C. Is a C something to celebrate? Probably not. But compared with what you were expecting, it suddenly feels like a pleasant surprise. Financial markets react in much the same way. Investors are constantly trying to predict the future. When they're bracing for disaster, whether that's soaring oil prices, worsening conflict, or major disruptions to global trade, even a small improvement in expectations can trigger a surprisingly large rally. That's why a single headline, or even one of Trump's tweets hinting at progress toward a ceasefire, can send stocks sharply higher. Not because the world has suddenly become safe, but because investors had already prepared themselves for something even worse. That brings us to another force that quietly shapes almost every financial market on the planet: interest rates. Don't worry, we'll keep this simple. Imagine you've got some money sitting in a savings account. If the bank is paying an attractive return, leaving your money there feels like an easy decision. It's safe, predictable, and requires almost no effort. But now imagine interest rates begin to fall. Suddenly, that same savings account doesn't look nearly as appealing. In fact, after inflation, you might actually be losing purchasing power. So investors begin asking a different question. If my cash isn't working for me, where else can I put it? That's when money starts looking elsewhere, into businesses, into real estate, into stocks, into gold, into almost anything with the potential to earn a better return than cash sitting in the bank. And when millions of investors begin chasing the same types of assets, prices naturally start to rise. It's one of the simplest laws of supply and demand. More buyers, same assets, higher prices. We saw this play out after the 2008 financial crisis. To keep the economy from falling into a deeper recession, central banks slashed interest rates to historic lows. Borrowing became cheaper. Investing became more attractive. Money flooded into financial markets. The same thing happened during the pandemic. As economies shut down around the world, governments and central banks pulled out every tool they had. Interest rates stayed exceptionally low. Cheap money encouraged borrowing. Borrowing encouraged spending. And spending helped support businesses and financial markets. The result? The value of almost everything climbed. Stocks surged. House prices soared. Bond prices rose. Private businesses became more valuable. Even internet joke coins with dog logos suddenly became billion-dollar assets. But wait, that explanation doesn't fully fit today's market anymore. Interest rates today are dramatically higher than they were during the years following the financial crisis. They're also far higher than they were throughout most of the pandemic. If borrowing money has become more expensive, why are stock prices still sitting near record highs? Clearly, something else is helping push markets upward. And that's where government spending enters the picture. Whenever economies face a major crisis, governments typically step in by injecting huge amounts of money into the economy. The goal is simple: prevent the economy from grinding to a halt. Some of that money reaches households through stimulus payments, tax relief, or government support programs. Some helps businesses stay afloat. Some supports banks and the broader financial system. But money rarely stays where it's first injected. It moves, it circulates, it changes hands, and over time, a significant share of that money ends up in the hands of investors and institutions that already own large financial assets.
Here's why that matters. Most households spend that extra money. They pay bills, buy groceries, or cover everyday expenses. That money quickly flows back into the economy. But large investors and financial institutions usually do something different. They buy more assets: stocks, property, bonds, businesses. And as more money flows into those assets, their prices rise. Not necessarily because the economy has become stronger, but because more money is competing to buy the same assets. That's why record-breaking stock markets can exist alongside record levels of financial stress. The two aren't contradictory. They can happen at exactly the same time. But that's still not the whole story. There's another force quietly pushing investors toward assets even when the future feels uncertain. Confidence in cash itself. Cash feels safe, but its biggest risk is often invisible. Every time governments respond to a crisis by creating more money, the supply of currency increases. And when more money exists in the system, each individual unit of that currency can gradually lose purchasing power over time. That's one of the reasons inflation matters so much. It doesn't just make everyday goods more expensive. It slowly erodes what your cash can actually buy. Now, consider the position many investors find themselves in. If inflation is reducing the value of cash and savings accounts aren't keeping up, holding large amounts of money suddenly starts feeling expensive. So they begin searching for places where they believe their wealth will be better protected. Stocks, real estate, gold, almost anything they believe can preserve value more effectively than cash sitting idle. This helps explain why money continues flowing into financial assets even during periods of uncertainty. It's not always because investors feel optimistic. For many investors, the choice isn't between a good investment and a bad investment. It's choosing the asset they believe will lose value the slowest. So where does all of this leave us? The stock market can't rise forever. No market can. Every cycle eventually reaches a point where expectations become too optimistic, prices become too stretched, or something unexpected changes the story. History has shown that time and time again. But perhaps the more interesting question isn't whether markets will eventually fall. It's why they're rising in the first place. Because record-breaking stock prices don't necessarily mean everyone is becoming wealthier. Very often, they mean the value of financial assets is rising faster than the incomes of the people trying to buy them. The people who already own businesses, stocks, and property see their wealth grow. Those still trying to build that wealth often find themselves chasing an ever-moving target. That's why a booming stock market and growing financial hardship can exist side by side. They're not opposites. In many cases, they're two sides of the same story. Understanding that changes the way you look at every new market record. Instead of asking, "Why are stocks so high?" you start asking a different question. Who's actually benefiting from those higher prices? Because once you understand how money flows through the financial system, record highs stop looking like a celebration. They become a clue about where wealth is being created, where it's accumulating, and who is being left behind. If you found this video helpful and want to better understand how money, investing, and the economy really work, subscribe to Logical Money. We break down complex financial topics into simple, practical explanations, so you can make better financial decisions with confidence. Thanks for watching, and I'll see you in the next one.